Good morning, everybody. Take two on January 5th, 2023. I had started the webinar without audio, got a little bit of practice, so hopefully this one is much smoother for you. I am currently watching the Consumer Electronics Show in Vegas via live stream and recordings. I invite you to stay logged in after today's webinar and then log back in the same credentials the next couple of days. I'm going to have this up and watching all of these. Consumer Electronics Show is where we rediscovered Ford a few years ago. And that's been a good investment for us. It looks like it's going to even be better going forward. I'm going to talk a little bit about some big trends here in just a second, but Consumer Electronics Show, pretty neat stuff. And we will see a lot of these. One of the ones that's coming up right after my program is about alternative energy right here. New era of home energy, EVs, solar, and storage. And this is interesting to me because I want to get into more and more real estate investing as we've talked about over the last few years. So why don't we move on? Some of the big trends that are impacting the world. We'll get into the global trends ETF, how we respond. And I want to give you a backdrop and then move into the more fluid things that we're hitting. But the big theme here is that the great divergence is accelerating. The shift from old economy investments to new economy investments is accelerating again. We're getting off of a plateau that we've been on, excluding, of course, the COVID push. It kind of looks like the Gartner hype cycle. We got that huge COVID push, a lot of hype about technology, and now it's all crashed or is crashing. And we can see what really is emerging. So we'll be able to pick out some winners and losers here. We won't be perfect, but we should be excellent. And just by knowing the type of information that the Consumer Electronics Show provides and following the money, right? It's always about following the money. So here you go. Demographics and destiny. This is an article from the International Monetary Fund from a couple of years ago. You've heard me talk about demographics over and over again. The original phrase was demographics is destiny, I believe from the late 1960s. What we know about demographics is that on aggregate, the planet is aging. The average age on the planet is going up. People are living longer in retirement, or people are just working forever. Depends on where you are and who you are. In Japan, which this article mentions, very old economy, very old population, oldest population on the planet among the larger countries. They are able to sustain themselves because most of their debt is owned internally, and they are a productive economy. They're small, but productive. There's not a lot of waste. The problem that they have is resources. Some of the things coming from technology alleviate those problems. One of the things that I was watching beforehand here was that John Deere is building machinery for construction and farming that cuts the pollution, cuts the aggregate materials needed for construction, eliminates the need for about half of fertilizers and over half of herbicides. They have ways to use technology and machines to target the chemicals so specifically, right? Rather than just spreading the field, they can target where the fertilizer or herbicide goes for maximum effectiveness and the least amount of waste. So what does that mean for companies like Nutrien, which we pretty much bottom ticked and top ticked? People think, I want to get a replay on Nutrien. And now the question I'm asking is, will there be one? I'm not really sure. I'm going to have to go through the numbers and think about it. If there's less and less fertilizer necessary, how does that impact farming? So those are the things I want us to think about, is not looking back, say, oh, I had a great investment with Nutrien where I tripled or quadrupled my money, but is that going to happen again? I'm not so sure. Other areas of the world are also getting old. Europe, I think, is doomed to a mediocrity. Europe tries to let people in to offset their demographics issues, and it's the smart play. It's what the United States should do too. The problem is that they have so much accumulated debt in the South and different work ethics from region to region to region and different education levels and just different outlooks on life that on the whole, the EU is going to continue to struggle, in my opinion. The UK probably left for xenophobic reasons. However, when you start to look at the numbers there and you start to think what they could be doing in the next few years, the UK looks like a pretty darn good investment. And I say that having just noticed some things in the news. The other day, they published that 88% of their energy, and I don't know if it was for a day or for a week, came from alternative sources. Think that through, 88%. What have I said about the US energy grid at some point? I have said that we'll be 80% alternative energy sometime in the 2030s. Now, if we could build it fast enough and avoid the political opposition, probably could get it done by 2030 with the machinery that's out there to help us build it. It's probably going to take an extra 10 years. But by 2040, we're probably 80% alternative energy. A lot of solar, some wind, hydroelectric, obviously, some geothermal. I think that that's going to get more popular. And we talked about fusion. Now, I have an expert in the field that sent me an email, and he said, here's something about the fusion to keep in mind. The input for the energy probably wasn't all inclusive. It probably was only recorded at that point of impact. So the energy put in and the energy that came out, which was a 50% increase, didn't include the power necessary to get to the point of where the reaction was culminated. So there probably shouldn't be quite as much excitement about it as there was, but it's still going to come. It was a major hurdle. And the old saying about fusion was, fusion is 30 years away. This may have been the event that finally made fusion really 30 years away. But as we can see at CES, technology is moving fast. So maybe by sometime in the second half of this century, we do have fusion. Doesn't really matter to us right now as investors. We look out over the next 5, 10, maybe 20 years. And that is our investment horizon. And that's why demographics is so important, is what is this going to force into the future? In the last webinar, I talked about a conversation that I had New Year's Eve with some of the teenagers that were partying downstairs from us at the parents' house. And the jobs of the future are going to be taking care of the young, taking care of the old, and then running everything that needs to be run, not the traditional sense where they touch things. They're going to be running the machines or the computers that run the machines. So people are going to have programming, technical, and engineering skills. They're not going to put the widgets together by hand anymore. And we already know that that's been coming for 40 years. It's here full force now because of the robots. Things like robot chefs, automated medical devices. IMF was talking about this 3 years ago. It's right on top of us right now. All right, let's take a look at a couple of other things and move along here. Technology, demographics are big things. Back in 2021, my second half outlook, I suggested that SPY had to get to between 310 and 350 sometime late in 2021 or in 2022. Well, in 2022, it got down to about 350. I think it got down to 346. I think this 310 is still my bogey, right? That's what I've been talking about, around 300. I reiterated that in my forecast last year. Then I gave my official predictions in my forecast this year. So make sure you read all of these. These are based on economic indicators and my thoughts on generally how economics are working. So I want to get into something that's important. A lot of analysts out there now are talking about the Federal Reserve. And I'm going to tell you something. They're completely wrong about what they're talking about now, just like they were wrong when they told me I was wrong a year and a half ago. Everything that I said has come to pass and is going to continue happening because they don't understand the economics. They're not economically trained in most cases, right? You have guys writing articles about high dividend opportunities who don't care that there's nothing supporting the underlying businesses, that the companies are shrinking because they don't understand the economics, the demographics, or the technology that changes the world and directs basically everything in the economy. They look backwards. They say, I made money on this 20 years ago. I can make money on it again. And it's just not true. One of the things that we've talked about is that over every 30-year period, 1/3 of the S&P 500 goes bankrupt, outright bankrupt. And over 10-year periods, about 1/3 of the S&P 500 gets recycled out between the bankruptcies and companies that shrink down to the lower indexes. So again, I urge you, do not own the S&P 500 in any account or anything that's super highly correlated to the S&P 500. It's a crap index based on the past that doesn't look forward. The transition of that index is too slow. It should be easy for you to beat if you have some patience. Things that you bought last year will start doing well this year or next year. And then once you have that virtuous cycle going, where investments from the past couple of years are doing well, you can start focusing on what's going to do well in a couple of years rather than FOMO chasing everything that ticks up. And some of you do that. I see the posts, I see the messages, I see the emails, the chats, everything. Stop chasing today's performance. If you don't understand the trend and how to buy the dips, if you don't understand why something's going up, if you don't have the technical skills to trade it, don't. It is much, much easier to say, this is the direction the world is heading. Get on that road. And every time the road goes down a little bit, you buy a little bit more of the future. And after you've done that for a few years, you start to realize, hey, that thing that I bought 3 years ago for $7, they got it all the way down to $1. And I bought a little bit more and got my cost basis down to $2. Look, it's back up to $7. 3, 4, or 5 years out, I've tripled or better my money, but I was really down for a hot minute. And in most cases, because you're smart, you're actually right about most of those things you buy, but it's hard to do it in real time because we get scared. Just keep going back to your analysis. Keep going back to what you know about the future. The demographics drive everything. The technology advances, usually quicker than slower, and those things merge to create the future. Along the way, the government and the central banks break things, then fix them, break things, then fix them. So when the government breaks things or when the central bank breaks things, you buy, right? Because that's the low price, that's the coupon price. And when then the government and the central banks fix things and your investments become worth more than you thought they could become worth, which is usually the case because the FOMO people push things up, you sell it to them. Hey, you know that thing that I had an average cost basis on of $2 a share, or $10 a share, or $20 a share that are now 10 and 40 and 100? You really want that, huh? I think you're pretty smart. I'll sell you mine because I like you. And you go clack, 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 and you sell somebody something, or at least part of your position that's been going up. And you control your FOMO and understand that because you scaled in slowly, that allows you to scale out slowly at wide price points. So maybe that thing, let's say your average cost basis of 10, that you may have been down 60, 70% on at one point, now it's tripled, you can sell a third of it. Then it goes up another $10 because you get that spike at the very top. You can sell almost the rest of it. Maybe you keep a starter for old time's sake. If you walk through some of this information, it should be apparent to you what's coming. For what it's worth, I just made a lot of money doing some research for a hedge fund. And yeah, I'm going to trickle that into you, but I'm giving you the outline right now. Some of these investments that we have, they're not all my idea. There's a quid pro quo. When I help some of these hedge funds, and think of hedge funds not in the terms of billion-dollar corporations. There are a lot of hedge funds that are between $30 and $200 million. And they pay guys like me to help them with things that they're not best at. Because what they're best at is trading the market on a day-to-day basis. That's what they do. They sit there with their Bloomberg and they trade day-to-day. Not my thing. I can tell them which lanes to get into, and I'm telling you, it's technology. It's emerging markets. It's the change in the way supply chains work, with supply chains moving back to North America. It's countries like the UK that whatever their motivations were, I think it's going to work out. It's South America. It's Mexico and Canada. It's Australia. It's parts of Asia. It's not the Middle East. I tell you what, I think that the Middle East is never going to escape their destructive pathway. And I hate to say that, but no matter how much money they make on oil the next several years, once their spigot for oil money is turned off, man, I don't know what they're going to do. They haven't educated their populations to run economies. They're going to be screwed. The revolutions you see in the Middle East in the next 10 or 20 years are going to be horrific. And I think that it works out for them long term, but I sure don't want my money there the next time the big bomb drops. Not the biggest bomb, but just, bombs. All right, let's move on. Some of the outlooks. Here's Goldman Sachs macro outlook, and they talk a lot about financial conditions. So they have a financial conditions index, and it's not just interest rates. It's the whole way that big money moves in the economy from the government and central banks. How tight is the central bank making the economy, or how loose? And there's multiple components. It used to just be follow interest rates, but we are now 15 years into the quantitative easing economy. Now we're in the quantitative tightening. That changes the correlations on interest rates. And in fact, Goldman Sachs and JP Morgan talk about how interest rates and their correlations on the economy don't quite work as well as they did in the last century, because we've tinkered with the monetary system so much that quantitative easing and quantitative tightening are just as important, and maybe more important, than the absolute level of interest rates. And while I think interest rates are peaking right now and will peak sometime this year, if they haven't just already done it, that doesn't mean that quantitative tightening is going to change much anytime soon. And they're tightening the spigot on financial conditions a lot. Here's a chart from Goldman Sachs and Fundstrat and Bloomberg. They're all in on it, one of my many subscriptions. And it shows the financial conditions got tighter and tighter and tighter. We got a little bit of loosening, right? A little bit of loosening at the end of last year because people anticipated interest rates pausing. And now you see things tightening again. Will this, right, this arrow isn't determined yet. They're guessing this is where the arrow is going to be. Will we get tightening ending here in the next month or two and then a rebound? I think this is actually wrong. I think that we double bottom. I think that we see the economy get as tight the next several months as it was right around Labor Day, right from Jackson Hole till about November. Actually, they say it bottomed on October 14th. Right, this is the tightest that they saw, October 14th. Last 10 weeks of the year, conditions got looser almost to the end. Now we're getting tighter again. I think we're going to see down here. Now, whether Tom Lee is right or I'm right, the time lag difference is 3 to 6 months. So you can't just wait for an absolute bottom, right? You need to start scaling in right about now and really scale in heavy if we get down here. There are certain investments, right, because leadership changes from sector to sector, that you can buy now, and others that you have to wait for until later. So whether conditions get tighter one more time, or if they're about as tight as they're going to be, you have to take a look at the different sectors and figure out, where can I put some money now, and where do I have to save some money for later? We'll get to that in just a second. One economist, the guy who created or first observed how inverse interest rate structures forecast recessions, and his forecasting method has been correct. This is the inverse interest rate guy. 8 out of 8 recessions he's predicted. And he says that his indicator might be wrong this time, because in the last 20 some odd years, but really since the financial crisis, the correlation of interest rates to the economy has fell. It's not as perfect as it used to be. It doesn't mean that it can't work, it just means that it's less likely to work. And as I've told you, quantitative easing and quantitative tightening are a big deal, because that's actually physically taking money in and out of the economy, not just manipulating what's there via interest rates. And one way to think about this is that we get a slowdown without an outright recession, or if we get a recession, it'll be short and shallow. And what is the reason for that? Why wouldn't a slowing of the economy necessarily lead to something really bad? It's employment. We need more people, is what Jerome Powell said a couple weeks ago. It is almost impossible for unemployment to go up much unless there's a catastrophic situation. I mean, we're 5 to 10 million people short in the workforce. It's millions. It's not a little bit, it's a lot. The only real part of the economy that's contracting right now is technology, because during COVID, the technology sector built out a lot and hired a lot, because everybody thought, oh, look, this is it. This is the inflection point. What we're finding out now is we still might be a little bit a ways. Revenue streams are changing. So companies like Salesforce and Amazon are cutting some staff, 5, 10, 15% of their staff. Now, those people were generally making pretty good money. They were largely the reason why official aggregate wage numbers went up. So that's going to be a push down on inflation. You're not really seeing jobs disappear in construction or trades or any type of front-facing service or healthcare. You really can't see contraction anywhere other than technology and, to an extent, real estate, because that's the one that is very prone to interest rates, very tied to interest rates. So we're going to see leadership change here, quarter to quarter, month to month, but over a year or over 2 years, the big trend reemerges every time. And by year 3, 4, 5, you're through the choppy parts of a cycle into the middle of the S curve, where it's basically go, baby, go. So I don't know if he's right that his indicator might fail, but it makes sense. It makes sense that we may not get a recession, or if we get a recession, that it's short and shallow, which is what I've been saying for a year and a half, that when the recession comes this year, it'll be short and shallow because the number one indicator of pain is unemployment, and we're not likely to get it. Those tech folks will take their 4 or 5 months severance, so Salesforce is given, plus a bonus of 2 months severance if you do something for them. I can't remember what it was. So they're getting good severance packages going into the summer. How many tech people do you think are going to really look for a job much during the summer? It's like financial people. Hey, we got off. So you'll see some softening in the employment numbers and the wage numbers. Just like I told you, inflation was going to start to crash at the end of last year, a year ahead of time. I'm telling you right now that inflation is going to be completely subdued by Labor Day. Okay, you mark that one down. Inflation is going to have a 2 handle by Labor Day. And what does that mean? With inflation going away by Labor Day and interest rates in that 5 to 5.5%, maybe 6% range for the Fed, excluding the potential for international shocks, you'd probably expect the Fed to just kind of stand pat. But if there is an international shock, you can start to see them really start to loosen again. So it's either going to be a status quo sort of thing or loosening. There's almost no risk of the Fed tightening more than about here. The only thing that could possibly happen is we have a huge energy shock due to warfare. It's about the only thing that I can see juicing up inflation again. But even then, I don't know that the Fed thinks they can do anything about that. I mean, they shouldn't. They shouldn't think they can. Other than doing what? Keep the dollar higher using higher interest rates, which they can't afford to do long because the United States has to refinance $3 trillion of debt over the next 5 years. $1 trillion this year and then $500 billion the next 4. So all things being equal, they would love to see the long end of the curve go even lower, which they can do by slowing the economy now a little bit so that long rates don't go up yet. So getting through this year's $1 trillion is the most important because it's a big, big number. They'll have most of that refinanced by about Labor Day. That's about when the budget issues for the Congress go away, or they let us default and then the world ends. So keep an eye on Labor Day as a pretty big inflection point, right? Maybe I'm off by a month, but it's going to be around there when we start to run into a new bull market. So between now and then, there's some trades you can make. There's some cyclical things you can do. It's all based on pricing. So what investment did we make a couple of months ago that's doing very well, right? International. So this is something that Teresa posted. I had already read it. Some of the big risks around the world, Russia, China, somebody does something with a nuke or a biological weapon. Inflation shock waves really is tied to energy. Supply chains are moving. We already know how to deal with demographics. Iran in a corner. This is the one that I think is the biggest risk. I think that a Middle Eastern conflict has been likely for 5 years, and they've been avoiding it. I just don't see it happening longer. So something to do with an energy crunch, Russia, Iran. That's what I'd be most concerned about. This is basically worried about the emerging markets. I'm not so worried about that. If the dollar has to get super strong again, they suffer. It's just another buying opportunity. We know that about 3/4 of the growth in the world the next 10 years is in emerging markets. And most of that is driven by technology and consumerism. So we invest in the same things there that would have won here, 10 and 20 years ago. What's won here for the last 20 years? Consumer discretionary and tech. That's what's going to win in the emerging markets too. I didn't even get to this part. I don't know what the TikTok boom is. And then water stress. I've talked about that quite a bit. So this is a geopolitical website. They don't really talk about the Fed a lot, but they're aware of them. And they did not put the Fed in their top 10 risks. Here's something to keep in mind. Even though energy has come down a little bit, they still have about $1 trillion worth of energy that they're short on for the next several years. Relief in global gas markets isn't expected till 2026. Where have we heard that number before? I keep telling you, 2026 is a big year, and it'll stretch into 2027. This is the start of a major inflection point on energy. And now it's in Bloomberg. Seriously, how long have I been telling you about 2026? 2-3 3 years since CES 2020, right? This is the year. And now it's finally in the mainstream media. So we get this drop in natural gas prices. Why? Because everybody's adjusting and we have a stretch of warm weather, and FOMO works in reverse too. This is just another trade for a different group of people. Turn the chart upside down. That's what their trade book looks like. People who bet on natural gas prices to go down made a bunch of money. People who bet on natural gas prices to go up made a bunch of money. They piled money in, created a trend, peaked it, started shorting, created a trend. Now it's troughing. Natural gas investments that have come back a little bit are good investments. It'd be nice to have a new fortress energy sort of investment. You can go to websites from major corporations all over the world, and all of these trends that I talk about are there. Eaton, power, digitization, clean energy, right? What if I told you the major trends are? Renewable power, digitization, decentralization, right? Flexible energy systems, decentralization, renewable power, decarbonization, digitization. This is the future. This is the great divergence. If you're not focused on this, if you're fighting it, if you're trying to look backwards instead of forwards, you're going to lose money and it's going to hurt. Spend the rest of this year, just like you did last year, getting into these sorts of investments. We're still heavy in cash. That cash should be spent up sometime this year. Little at a time, wide price points, slow, but get it done. Here's the Global Trends ETF. It's also at fundamental trends. Cash holdings are remaining stable right now after raising a little cash in December, doing some shifting in the portfolio, slow-handed tactical moves, right? Not day trading. The risk is more international than from the Fed. However, do not expect to see easier money soon because quantitative tightening is unlikely to be cut before the second half, Labor Day-ish. The great divergence is coming faster than ever. So still heavy in cash based on our ranges, but now stable. You should not be a seller anymore unless you're out of whack. Core holdings made some adjustments. Tactical slice. Increasing my alternatives and my energy and my fintech. Let's take a look at this chart. This is XLE. Came up here. If we can get it in the 70s, that would be spectacular. I'm not sure that we will. Keep an eye on it. Selling puts is a wonderful strategy because this is a volatile sector, so it gets good premiums. Clean energy. Look at that. Massive rally. Near the bottom fishing. I think it's touching the buy zone right now. Oh, that's fintech. There you go. Same chart, basically. Clean energy coming way down. It's in the buy zone. Can it go lower? Sure. I thought the 36 to 38 was going to be the low a while back. I adjusted it down to 30 because price action. But you should be scaling into PBW again. Then fintech, which I love the top holdings, coming down. Probably got one more leg down. Remember, this all coincides with financial conditions. Get your bottoming process. Maybe we bottom ahead of the Fed by a few months. Remember, the Fed really wants to avoid a situation where energy problems can shoot up inflation. So as we approach the end of the drive season, and which coincides with war season, right? Because wars typically aren't fought in the winter. Middle East could be different because they don't really have winter. But once we get towards the end of the drive season, Labor Day, the Fed really has their handcuffs come off. By then, most of the $1 trillion of debt will be refinanced that the government has to refinance. We won't have as high of a need for gasoline and other oil-based products because it's the end of summer. And we are through the busiest part of the economy year and only 4 months away, give or take, from the first quarter, which is always the slowest quarter. So I think this is all pretty self-explanatory once it's explained. So CES, I'm going to jump into this real quick and we will call it a day. Have a good weekend and I will have a couple more articles coming for you.